Hello students, my name is Shesi George, your professional accounting teacher. Please, before you continue with this video, subscribe to my YouTube channel, The Georgian Troy Concept. Thank you. Alright, let's get started. In this video, we are going to look at the concept of standard contribution margin, that is SCM, versus standard profit margin, that is SPM. Alright. Now, to start with, what is contribution? Contribution is nothing but the standard selling price minus standard variable cost. Standard selling price minus standard variable cost. So, of course, this one will now be standard contribution. The standard contribution, okay? Or contribution is selling price or sales minus variable cost. All right, supposing you are given a standard cost card. So when you have your standard cost card, all right, and don't forget that standard cost card is a statement that shows the production costs per unit, expected production costs per unit, that starts with material, direct labor. These are the elements of the standard cost. Then variable production overheads. Then we decide to add these three together, and this gives variable cost. So this is standard variable cost or marginal cost. All right. So when you add this together, that is standard variable cost or marginal cost. Then when you have your standard selling price, okay, the difference between these two gives what we call standard contribution margin. Standard contribution margin. Supposing this is 500 naira, and supposing this is 200 naira, supposing variable overhead is 100 naira, then the addition of this is 800 naira. Then supposing the standard selling price is 1000 naira, right? The difference between these is 200 naira. So this is what we call standard contribution margin. And when you want to calculate your sales volume variance, the sales volume variance, which is actual quantity sold minus projected quantity sold, then multiplied by standard contribution margin. This is called marginal costing principle. Marginal costing principle or costing system or principle, okay, for the preparation of standard cost card. So if your standard cost card gives information on these three elements only, so you will use standard contribution margin to calculate your sales volume variance, okay? All right. If, however, you have a standard cost card, don't forget, standard cost card shows the costs, production costs per unit, estimated production cost per unit. Supposing you have direct material, supposing you have direct labor, supposing variable overhead you had, then here you have fixed overhead. Fixed overhead. Unlike this, we don't have fixed overhead here, but here we had our fixed overhead. So the total gives full cost. Full cost. This is full total cost. Full total cost. Okay. Then supposing our standard selling price. So what's our standard selling price? All right. Standard selling price. Say you are given this. So the difference between this and this is called standard profit margin. All right. Don't forget standard profit. Profit is nothing but standard selling price minus standard full cost. Standard full cost. And this full cost is the addition of fixed cost, standard fixed cost, plus standard variable cost. Okay. So students should not forget. Now we have 500, for example. Direct labor, our direct labor is 200, variable overhead 100, then this is and the total here is 850. Then let's say our selling price is 1,000, then the difference we give 150. So if you are asked to calculate sales volume variance, supposing you are asked to calculate sales volume variance, and that will be nothing but actual quantity minus budgeted quantity multiplied by standard profit margin. So this is called absorption costing. So if you are giving absorption, if the company uses absorption costing principle, you will use standard profit margin. So with this video, I've been able to explain when to use standard contribution margin and standard profit margin. If you love this video, please do share with your friends. Thank you. Bye for now.